Cannot. I like that. Very cool. All right. Well, it's good to be with you today. Thank you for coming today. Really looking forward to being with you today. And always good to see familiar, friendly faces. So before I start pontificating on what it is that I'm going to be talking about, why did you come today? What are some of the things that you came with, and what were you thinking about when you said, yeah, I'd like to come to that? So, Arthur, do you want to?
I heard NAR settlement.
Okay.
I would find all this information quite interesting.
Okay.
The more ammo we put in our arsenal,
Okay.
we can help make it a little bit easier.
All right. That's great. And what is your concern about the proposed NAR settlement?
Well, it's going to create a real bad, or I don't really know yet, but it's going to make buyers a little bit more difficult for them to purchase a property with limited money that they have.
Okay.
Especially with the prices of homes.
Right. Right. Okay. All right. Good. Very good. Okay. All right. We'll talk about that today.
I was going to say, ditto.
Ditto? Okay. So that's a big concern. Okay. All right. Michael?
Yeah, so, right, as we look at the buyer's agent and we look at the buyer being possibly having to pay, I want to think out of the box.
Okay. Okay. We'll spend a little extra time on that then. Steve? It's Steve.
Yeah, I want to know more detail about NAR policy.
Okay.
Also, more detail on bridge loan.
Okay. Bridge loans. Good. I like that. Okay. And
Shauna.
how are you, Shauna?
Good, Mike.
Good.
I was thinking the marketing on people who be in the reverse mortgage category.
Okay. We got some good stuff on that. That's great. Hello, dear. It's so good to see you.
Good to see you too. Well, first of all, Gina invited me. I'm here, but not as a student. No, I'm here is because I want to hear, of course, I already know about the NAR settlement.
Okay.
Hear other people thoughts and, to see maybe different opinion or different perspective.
Okay.
How people see how this can affect us.
Okay.
Industry.
Okay. Good. Good. And Vince?
Just learning more about the different strategies on how to combat this NAR
Okay.
settlement.
Okay. And Alex?
Just to see if it changes anything in the lending part, kind of.
Right. Okay. Okay, we'll talk about that. All right, so when we talk about the NAR settlement, the proposed NAR settlement, we're really talking about how much value can you bring to the client, right? That's the bottom line. The bottom line is, what can you bring to the client that somebody else cannot? And you as a real estate professional. And so we're going to get to the NAR settlement in just a few minutes, but first of all, we're going to talk a little bit about what's your story. Now, I know that some of you have attended before, so I'll blow through this as quickly as I can, but it's important that, that we start with this, because I believe that your story is one of those things that will make a big difference in presenting to your clients. So people have asked me, they said, John, how did you write your book? So this is my book right here, Buy Your First Home Today. And they were interested in that, and they said, what happened? How did you come about being able to do that? And so what happened is, just to give you a brief background, I finished the book at about 10 a.m. in the morning, and I flipped it over, or about 2 a.m. in the morning, I flipped it over, started reading it, and lo and behold, it was the worst book that I've ever read on mortgage financing. It was horrible. It was just really bad. And it was really dry, and I thought nobody would ever want to read this book on mortgages. There's no way. And so I went to a seminar in New York as a way to promote my book, to figure it out how to do that. And what would happen there is that we had 3.5 minutes to give pitches. And these pitches I gave to literary agents, publishers, producers, people like that. And the first day I was there, it was so bad, one guy said, John, nobody here wants what you have. You might as well go home. And I spent all this money to get to New York to do this. I had 80 pitches lined up over 3.5 days. And so I was ready to basically just pack it up. So I turned to my wife. I said, well, you want to go see some shows? You want to leave? But then something said, no, you got to stick it out. You got to stay. And so as a result of that, the next day I went up, and the feeling came to me that I needed to tell my story. And I thought to myself, that's really a bad idea. Nobody is interested in hearing what I have to say about my story. But I was so desperate that I was driven to be able to do that. So I basically said to the first guy that I walked up to, I said, "Hi, my name is John Mallett." And a little bit about me. My father walked out on our family when I was 8 years old. From ages 8 to 14, we moved 5 times because we couldn't pay the rent. And I ended up living in the government housing projects. And 2 years before that, my mother contracted multiple sclerosis, was diagnosed with that. And at 18 years of age, I stood by her bedside as I watched her pass away. And I'm here to talk about home ownership and the stability that it brings to people's lives. And I'll never forget it. This guy had his mouth a little bit open. Usually they come back with really quick responses, but he actually paused for a few minutes and he said, "I really like your story. I want to hear more about it." And after that, it was a laydown as far as getting people interested in what I had to say. And so that's the question I have for you today so what I did was I went back and I rewrote the whole book into a story format to make it so that it was an aspirational book about people who didn't think they could qualify, but they really could. And so one of the questions that I really want you to ask yourself today as we go through this for just a short period of time with you is, where do you add the value? Where do you make the difference in somebody's lives? Because that's really what we're all about. And telling your story is really powerful. I can tell you right now that if you get your story down, and this is something that we do podcasts and we help you tell your story. We believe that when you help and you tell your story and you're able to articulate that to a really refined out, you'll be able to connect with people on a much deeper level. They'll know about you so much quicker than normal. It makes a big difference. And I believe that that's where we begin to have and provide value to our clients, because that's what's going to make us different, right? And all of a sudden, the buyer's commission, money, things like that, that's all important, but all of a sudden, the value of yourself comes in because you're taking people in a leadership position and you're taking them into the future that is uncertain. And they want to know that you're grounded and comfortable. Okay, so the question that I want you to ask yourself, that we are asking more to our clients as we talk about value, is we talk about what it is that we do. And so I want to give you this right here. This is probably the most important thing that I have to say today, is this graph right here. Now we're going to talk about the NAR settlement in a minute, but this is really a big deal. And the reason it is that the preparation aspect right now of mortgage financing and of real estate sales, right now, the key is your preparation, right? So as a lender, if I take a loan and I decide to just throw it against the wall, then what happens is it's in your packet that I gave you. It starts out really easy here, but have you ever had a transaction that as you go through the transaction, it gets worse and worse and worse? Have you ever had that happen to you? Okay, I mean, what would be an example of that?
Surprise.
What's that?
Surprise on the client's part.
Yes, surprises, right?
Like judgment or lien on their
Right. Yeah, that should have been picked up earlier, right? And so the problem is that when you get to closing, this is the effort that it takes to close the loan simply because there wasn't the preparation put in. And my wife and I have lots of talks about the fact that I pay more money out to my team because what we do is that we focus on this. So 80% of our time, of our efforts, are all put into preparation. And by the way, this is a great slide to give to your clients. If you want to, we can change it, put your name here, and it's a great presentation when you're doing a listing presentation or a selling presentation. But the whole idea is to take care of all the hard part first, and so when you close, it's simply signing the documents and you're done. That is beginning to add the value that you can bring to the table. The value is being able to have so much confidence that your clients say, yes, I want to work with you. Yes, I can pay that commission. Yes, I can make this work. Any questions about that? Any thoughts? This is really important. This is like really, really important. Okay, the next question is, is you want to ask yourself the question, am I curious? We're starting to ask more and more clients, we're starting to say, I am curious. What is it about your home? We ask this question. If there's anything you could change about your home or living environment, what would it be? A lot of people right now are prisoners in their own home because of what? Why do they stay in their home right now? Right, because they're prisoners in their home because they got a low rate, right? And so the question that you want to ask, and we're getting to a deeper conversation. So what we're talking about is getting to a deeper conversation with your clients, telling your story, asking questions, getting a little bit going on of what's going on in their life. And it's amazing what happens. We had a friend of ours. She had a smaller home. She was not thinking, she didn't really want to buy another home, but her kids were starting to leave, and she wanted the opportunity to be able to give more room to her children. She'd have grandchildren, had a rather large family. And so she walked into this home, and she saw the kitchen, and she basically loved the kitchen. She bought the kitchen for $1.2 million, and then they threw in the house and the yard. That's basically what happened. And like Danny said, the kitchen is where it's at. And when she bought that kitchen, it transformed their lives, their family's life. Why? Because she liked to cook, just like Arthur does. And so all of a sudden, more food began to be prepared, and then more people come in. I mean, what happens when you start cooking food? You get people coming in, right? You get a little bit heavier, right? But I mean, it's really cool. And so her life was transformed. Her family's life was transformed. Why? Because she lived in the property that was right for her. And I think a lot of times people talk about the idea of buying a home, home ownership, because it's the smart financial thing to do. Well, that's pretty obvious that it is the smart financial thing to do. We all know that, right? But the key is how to get to the point to where people will trust you. And I think that the really good key here is to have the deeper discussions. Because your home environment is where it's at, right? When you go home and you're in your home, that is where it's at. And getting in the right environment is key. 37% of people who rent can buy, and most of them don't know it. That's a big number. And I think personally, and we've done a little bit of work on this, but we believe that there's anywhere from 10 to 15% of people who live in their homes and hate it. They don't want to live there. And wouldn't it be nice? That's the low-hanging fruit, in my opinion, of where it's at, the market's at right now. We think that there's not a lot of inventory out there. I can tell you that 10 to 15%, maybe even 20% of the people you talk to are not happy where they live, even though they own their own home. Have you ever had that happen? Have you ever seen a person? What are some of the reasons why somebody would want to make a change? What's that?
A life-changing event.
Yeah.
With death, retirement, relocation.
Right, exactly. What would be some other reasons? Expanding family, okay. So, I mean, there's all of these things going on, and a lot of times they don't tell you, right? They can't get to the deeper level, but you can with your story and with the value that you bring. Okay, all right. And then, of course, asking your clients, what are the possibilities and what are your dreams? All right, so let's go ahead and get right into it. Interested party contributions. Fannie Mae and Freddie Mac. They came out with a recent written notice to all lenders. And basically, this is what they said. Interested party contributions, this has to do with the NAR settlement. Interested party contribution permits interested parties, including property sellers, to make contributions to the borrower's closing costs, subject to maximum limits ranging between 2 and 9% of the property value, right? Okay, so what that means is that the seller can pay closing costs for the buyer, correct? It's anywhere from 2% to 9%. The more money you put down, the higher there can be for the seller contribution. Okay, then it says, if a seller or seller's real estate agent continues to pay the buyer's real estate agent commission, this is critical, in accordance with local, common, and customary practices, these amounts are not required to be counted towards the interested party contribution limits for the transactions. So what that means is that the commission that is paid to the seller, to the buyer's agent, in most cases, is customary. Is it customary in our area for the seller to pay for those costs? Yes or no? Yes, right? It always has been, right? It's considered customary. And as a result of that, that means that if your commission is 3%, it does not interfere with the percent for the seller commission. That's a really big deal, because what they're saying is that I can give the seller can say, okay, I'll give you 3% of the money towards your closing cost. The question is that if the loan to value is only at 3%, can the seller also pay the commission for you, the buyer? Is that yes or no? Yes, they can. So let's say that you've got a loan to value, you've got a situation where the seller can pay up to 3% of the buyer's cost, right? 3%. And you also say, well, for this transaction, I'm charging 2.5% as the buyer's agent. So the question is, can you get the 2.5% plus the 3%, even though the 3% is all they will allow with that particular transaction? Will they allow you to get the 2.5%? And the answer to that is yes. So that means that when you are in a position of negotiating with the seller, you can ask for that, your buyer's commission. And it will not interfere with any selling commission or any credit towards the closing cost. So what that tells me is it's business as usual, right? So if you go in and you make the offer, and let's say that the house is $900,000 and you want the buyer commission, you can actually make an offer for a little bit more than that for the 2.5% that you need to make up, and you can make it happen. What questions do you have about that? Get a few stupor thoughts looks here, so I want to make sure I'm explaining this correctly.
So maybe we can do an actual scenario.
Mm-hmm.
Okay. We're now into the middle of July.
Okay.
And it's been implemented.
Okay.
And I have a buyer, and they're not going to pay me a commission. So.
Okay. Let's say that the sale is $1 million,
Right.
right? And what's your commission?
2.5%.
2.5%. Okay, so we want 2.5%. So the question is how do you get that? Is the seller willing to pay that or no? Are we assuming that the seller is not willing to pay that?
Let's talk about the seller's not willing to pay it.
Okay, so is it possible when you make the offer that you can say seller to pay buyer's commission of 2.5%?
Yes.
Okay, you can do that, right? Okay, so the question is when the seller comes back and does the counter, what does that mean? So that's why you have to really look at it and see, okay, where do I need to be? And most agents are saying, well, we're going to add to the price, we're going to increase the price by that particular amount of money. So in that case, it might be $25,000.
To the offer.
To the offer. Mm-hmm. And as long as it's going to appraise, which at $1 million, it should usually do that. You can do that. So you have that capability of doing that.
Good. Good.
Okay?
Yeah. So let's go back to that's not going to work. Then you have obviously now you have your buyer consultation. And have you gone through that scenario?
Okay, so the buyer has signed the buyer's
Broker
agreement, correct?
Right.
Okay. So then the question is, can the down payment come from, your commissions come from the down payment? No, it cannot. Cannot. Right. Unless they pay it in addition to what the closing costs are. In addition, yeah. So, there's a couple ways that you can skin the cat. The first way is to ask for it from the seller, because more and more that's going to be what's happening. I mean, as a listing agent, there's a lot of listing agents out there that will be saying, no, my charge is 5% commission. I'll take care of the buyer's side.
And same as it's always
Same as
been.
it's always
It's just
been.
not published.
Exactly. And they can do whatever they want. The RPA clearly says that the seller is not going to pay the buyer's commission. So there's a lot of ways that you can work with it. But again, it's the value that you're giving and how you're presenting it. Instead of crediting the buyers with the closing cost, you take the commission. Right?
Yeah, no, it's good.
Yeah, right.
To get the thing-
But the important thing is that from a lending standpoint, lenders, now FHA and VA have not come out with their opinions on this yet, but the lenders are very straightforward on Fannie and Freddie Mae and Freddie Mac, that these are 100% acceptable for you to ask for the buyer's commission in the transaction. Okay. Right, so then it really becomes, what is the value, right? What's the value proposition? What questions do you have about this before we go on? You must have some. Vince?
Very basic. How can a buyer control the maximum limits of 2 to 9%? What are those contributing
It
factors?
depends on what they put down as far as the down payment goes. So if the down payment is less than 10%, the seller can contribute up to 3%. If the down payment is 10 to 25%, it can be 6%. If the down payment is more than 25%, the seller can contribute 9%. FHA is 6, VA is 4. But that's all in addition to the buyer's commission. Okay? Right. So, what other questions about that? I'm going to make sure we got that right. Okay? Yes.
You know, the traditional way, I think, is just the most simpler and easy when you are entering a transaction. My concern is with the new settlement, does the seller not upfront with giving commissions to the buying agent, and the sales price or the contract price is already at the max, and then now you added another 25,000
Right.
on top of that,
Right.
which is contract.
Mm-hmm.
It's going to be challenging for an appraiser. What if they don't able to come?
That's right. Right.
You know,
That's
to
exactly right.
include that 25,000.
That's right. So then you've got to see, will it appraise, right? That's the big question.
But I mean, this is like worst come to worst, that is already at the max, because you know that the market is crazy right now. Everything is like above the asking price.
Right.
So to have to add an additional 25,000 commission on top of the high price already, that is really running the risk.
Yep.
When it comes to an appraisal.
That's right. That's right. Yep. And that's a big deal. That's where you have to really say on the comps, is the value going to be there? Right? Yep.
Yeah, I have that conversation with my seller already.
Mm-hmm.
And originally, she thought it's, I don't have to pay my agent. And I bring that up about the appraisal, make her think,
Yeah.
okay, I don't want later on have to, bring down my sales price.
Right,
That's
right.
why I asked her, just give it, but at least she get it the max.
Yeah.
And, go with, easier, without any issues.
Mhm.
Negotiate.
Right. Yeah, so that's right. But your appraisal is going to be a key issue, right? So you just got to make sure that it's going to work. But that's all part of the transaction. But the key is to use some strategy within your financing to see if you can make that work. Okay, good. I appreciate that. Thank you. Okay, so let's go on. Okay, first of all, financing. We have conventional, governed by Fannie Mae and Freddie Mac. We all know about that. Los Angeles, the highest high balance conforming loan amount is $1,149,850. In Ventura County, it's $954,500. All right, and then give you an example. In Ventura County, if your loan is a first, you have $954,500, 5% down, gives you a purchase price of $1,004,700. The nice thing is you can use a line of credit, and the line of credit, you can do another $500,000. And this is a mistake right here, but this is about $1.6 million in purchase. So it's amazing what can happen when you use conforming financing. Now this is a really big deal because values are going up, right? And so we're wondering, well, how can we make it so we don't have to get into jumbo loans? When we do jumbo financing is more restrictive. You've got to have lower debt-to-income ratios, like around 43%. With high balance conforming, you can go much higher. You can go up to 50%. If you have a second, you can go up to 45%. So there's all of these intricacies that a lot of people don't look at when they think about the idea of, can I qualify? What do I need to do to qualify? Because a lot of people have the income, and you would be amazed at the number of people that have income. We had a first-time homebuyer seminar, and in this seminar, we had, everybody was raising their hands. They wanted to know what the first-time homebuyer benefits were. And then I talked to one couple afterwards, and they said, well, what happens if you make more money than the $138,500 for Ventura County? And I said, well, we've got another program that you can go up to $191,000 and still get benefits. And he said, well, that's a problem because we make more. And so I'm telling you that there are thousands of people in Ventura County that make a lot of money that don't have a big down payment. And so when it comes to be able to strategize and put other strategies together, there's amazing things that you can do that you'd never thought possible. And that's why it's so important to bring your client and get them pre-approved, especially for those who you don't think can qualify. Because now we go on to the next one. The next one is VA financing. In our area, we have a lot of VA, 100% financing. Some lenders will allow VA financing, 100% financing, up to about $1.8 million purchase price. So it's a big loan for nothing down. So it's their ability to qualify. It becomes their income. And VA, of course, has no mortgage insurance, and they allow for much higher debt-to-income ratios as well. FHA is the same thing. You can go down to a 580 on a FICO score for FHA. I mean, think about that for a minute. That's amazing, right? And you can go below that also if they have 10% down. So the government financing that you can get right now is enormous. Self-employed. Let's talk about it. We'll go through a couple of case studies and give you some examples. Right now, the self-employed borrowers for real estate professionals is the touch of death in a lot of ways. And it's simply because they don't fit the box, right? And so as a result, it gets pretty challenging. Right now with the self-employed individuals, we have lenders that will do even 3 months bank statements with a profit and loss statement. Now, they got to buy responsibly. We're not talking about buying something that they can't afford. That's not what we're talking about. But right now, the idea is that bank statements, we had a client that we just closed the transaction with, and his name was Pierre, great guy. His tax return showed $40,000 a year in income, but his bank statement showed $20,000 a month. And so the lender is going to take half of that, and then basically it was $25,000. So then his earnings were considered to be at $12,500 a month. Now the interesting thing is because he didn't have a lot of overhead, the lender didn't take 50%. They only took 20% off the top as far as expenses go, and he qualified just fine. It's amazing what you can do when you really get into self-employed borrowers. The income that they receive through their bank statements is enormous. And just like you as real estate professionals, when you're doing your tax returns, I can tell you that your cash flow through your bank statements are going to be a lot higher than what you report. That's the whole purpose of being self-employed. Okay, we're not going to go through all these, but just to kind of give you an idea, we do restricted stock units. We do it, there's no credit score that's required. You can do it with an I-10 number. You can do cross-collateralization that we'll talk about. There's to-be-determined approvals. There's so much that you can do for self-employed individuals. It goes beyond what most people think is possible. And so when you have a self-employed individual, because today, the whole purpose of this forum that we're putting on today is for you to get more sales than you would normally have. All we want you to do is get 3 or 4 more sales this year than you would normally have. That's all we want. Just a couple more sales, right? That's what we're talking about. We're talking about doing that by using financing. Okay, ATP stands for ability to pay. And so when it is a owner-occupied property, they're buying it as to live in. We just closed a $1.6 million loan on a self-employed individual, and he had plenty of cash flow, lots of cash flow, to make that payment. And that was the house that he was going to live in. And then also for investment purposes, we have debt service coverage ratio. It's called the DSCR loan. How many have heard of these loans before? I mean, they're pretty amazing. They really are. It just means that if the rent will cover the payment, they will make the loan on that property based on that rent and that payment. And if the payment is lower than the rent, or I'm sorry, if the payment is higher than the rent, they'll go down to as high as 0.75%. So, or 0.75. So the whole idea is that when people are buying investment properties and they're self-employed, there's absolutely no reason why they can't do it. I mean, it is amazing what can happen with this. All right, this is a true story. This is a deal that we just closed recently. Mark came to us. That's not his real name. We changed the name to protect the innocent here. He came to us and he said, John, I want a loan of $1.5 million. He owns a rental property that was worth $2.5 million. He owes $500,000 on the property. So how much does he want in total loan amount for the new loan? How much does he want? $500,000 and he wants 1.5. So he wants $2 million, right? All right. So you take the value of the property, which is $2.5 million. The loan amount's $2 million. You take the $2 million, divide it by the 2.5, and it's a loan to value of 80%. He does not qualify. No way that I can make that loan go, because he didn't have tax returns. He said, by the way, I want $1.5 million, but I can't give you any tax returns.
With tax returns?
Oh, it's a piece of cake. Right, yeah, right.
Yeah.
But no tax returns, okay? All right, so then the question was, well, what can we do? And I said, well, do you happen to own any other properties? He says, yes, I own one more rental. Well, now we get really interesting, because the way that this loan had to be structured is it had to be in the name of the individual, but it had to also be in the title. It had to be the title of the individual, but the note had to put in the LLC, which is really backwards. It's really strange how they had to have it. So we couldn't go to a conventional lender for that. We couldn't even use bank statements. But the question is, what's next? Well, all of a sudden, he owns another property that's worth $2.2 million, owes $500,000 on that. So all of a sudden, what happened is we have a property for 2.2, we have another property for 2.5 that equals 4.7 total. Loan amounts on both were $1 million. So he owned $1 million between the two property, and he wanted $1.5 million. So what's that give you? $2.5 million in loans, right? So he wanted 1.5 and he owed $1 million. So now what happens is that you take what he wants of the 1.5 million right here and add that to what they owe of 1 million. It's 2.5 million, but now it's divided by $4,700,000. That's called cross-collateralization. And we do it all the time. It's private money placement. People would refer to that as hard money. It's not hard money. This was not a hard money case. They had fantastic credit. They had reserves. They had all this. They had everything going for them, but they could not document their income. But what we had to have was we had to have a lower LTV. It came in at 53%, and as a result of that, they got the loan. Isn't that cool?
What was the interest rate?
Interest rate on that was, I think, 10.25%, right? Yeah, it was an investment non-owner occupied, all right? So that's cross-collateralization. It's amazing how these work, and we do these all the time. There's a lot of demand for it. Okay, let's go to the next one. Let's go to bridge loan financing. Who knows about bridge loan financing? What are your, when you hear bridge loan financing, what is that? What comes? Bridge loan financing.
Is that people buying their home, subjected to selling their current home, but they still able to buy and enter escrow with their new home before they get the loan, the bridge loan, for them to buy the new home.
Uh-huh.
So after it's closed,
Exactly. So it's a non-contingent offer, right? So they want to buy the property on a non-contingent basis, right? So that they can buy it, and they can buy it the same as cash, is basically what it is.
So the bridge loan, when the buyer submit an offer, proof of fund is gonna be subject to sell that, or proof of fund?
No, no, no. So when you get a,
Loan is already in their bank account.
right, so when you get the bridge loan financing to the seller, when you make the offer on behalf of your client, and it's a bridge loan, it's the equivalent of a cash offer.
Even though the house, even though there's no money in the bank account, but they submitted the paperwork like us, like a
Correct.
bridge loan.
Right,
finance.
right, right. It could be a cash offer, or it could be a blend between the two, right? Welcome. Hi. Okay, so I'll give you an example. Here we go right here. We have a home, a current home that's selling for $1 million, and with bridge loans, they'll give you up to 75% of that, so we get $750,000. They owe $200,000 on it, therefore, they get $550,000 for the down payment on the home they want to buy. Does that make sense? Explain that okay? All right, so they get 75% of what the value is worth. They subtract what the outstanding loans are. The lender is going to give $550,000 towards the purchase price of $1.5 million. So that means that this individual who's buying this home, going from this home to this home, needs to come in with an additional cash or a loan for $950,000. All right? So that's how they would buy it on a non-contingent basis. But what people forget about with bridge loan financing is when you go to private placements, then all of a sudden it gets really interesting. Because when you do private placements, they will cross-collateralize both properties. And when you cross-collateralize the home that they have and the home that they're buying, then all of a sudden it changes the whole picture. And this is an example for you right here. So here's what we have. So we have property value is $1 million that they currently own. The property that they're going to buy is $1.5 million. The total equity is $2.5 million. Most lenders will give up to 65% or more. That means that there's $1,625,000 available for the purchase of the home. You take away the $200,000 that they originally had that they owed on this home, and they have $1,425,000 for the purchase of the $1.5 million home. All they have to come up with is $75,000, and they're in their house. Now, this kind of loan just makes me weep. I mean, it is amazing. It's so cool. We just closed a loan a little while back where a family bought a $1.7 million home with no money down, simply because they had the equity in the home that they were selling. No money down. All they had to do was come in with the closing costs, and that was it.
So let's go through it.
Oh, hold on just a minute. Yes.
So a buyer has to do that with their own home, they wouldn't be able to do it with one of their investment properties?
Sure, they can. Yep, they sure can. If it's a private money placement, because that's what this is, private money placement, they can actually cross-collateralize another loan.
What do you mean by private money placement?
So we have Fannie Mae and Freddie Mac, so we have conventional financing. Then we have government financing, right? And then after that, we go to non-QM. And Fannie and Freddie have what's called qualified mortgages, QM mortgages. That's a really good question. Non-QM is the next step. And the next step is non-QM, which is non-qualified mortgage. That means they don't follow the guidelines of Fannie and Freddie, and that's where they'll get into doing bank statement loans. That's where they get into doing all of these other financing that the normal loans won't do. So when an insurance company wants to buy $1 billion worth of loans to be able to service their policyholders, they will buy from Fannie and Freddie because they know exactly what they're buying. But when they get into non-QM, then all of a sudden it's a little bit different because those tranches that these investment houses buy are purchases for bank statement programs. So the risk goes up a little bit, right? Okay, so then now we go to private money. So you have non-QM, and then you have private money. And private money It used to be called hard money, right? And hard money was where you had people that had 550 scores, they were in desperate situations. Now it's transitioned to, since Dodd-Frank and since the subprime crisis, now it's transitioned to private money because you have very well-qualified individuals that have great credit but need the details with private money, which is no income documentation as a general rule. Sometimes they want it. And really creative financing.
So the interest rate on these, bridge loan financing, typically would be
Higher, exactly right. So conventional is going to be your lowest, along with government. And government is lower, and then you have conventional, and then you have non-QM, and then the private money. And the private money, what makes it so interesting, especially with bridge loan financing, is that these loans are for 11 months. So it's short-term financing. So the question that you asked was a really good one, because what if they have another property that they want to collateralize? They can do that as well. So the lender can make a loan to a property based on the collateral from another property or another property. They can actually put all three of them together.
So at the end, once this is done, once the sale has been completed, it's an 11-month short. Oh, but you still gotta get financed for the difference.
Right. Right. And so you simply pay off the financing of the bridge loan. Now you've got to service the debt on the bridge loan while it's going. That's important. But a lot of times you can actually put that into the loan itself so you don't make any payments for 6 months. So there's pretty creative things that you can do. And that's where we come up with saying, okay, let's do one extra loan. Let's do one extra sell this year. What would it look like? Right? This may be a deal that would come up to say, somebody says, no, we can't do it. And then you go, well, wait a minute. We've got equity in this property. We're buying this property. What's the possibility of doing bridge loan financing? That's your best option, right? Thank you. Michael?
Okay, just to go through that, you get the current home is $1 million.
Yeah.
Right?
Right.
Other home is $1.5 million.
That they want to buy, right?
They want to buy, so that's $2.5 million. You can use 65%.
Yes.
Of it.
And some lenders will go to 75%, even private money. But I gave a more conservative estimate.
Okay, so what's your minus 200?
That's what they currently owe on the home they're selling for $1 million.
Okay, so they owe, okay.
So they owe $200,000 on it, right?
Got it. Okay, and you're able to get 65% by adding them for a loan, and then they'll have to come up with, what are they going to have to come up with again?
$75,000. Right here. All right. So what happens is that they have access to $1,625,000. We're going to subtract what they currently owe on the home. Now, by the way, let me ask you something. Over the last for 20 and 21, what state or states had the highest level of dollar appreciation in the country? In 2021, California and Hawaii were the highest. The average amount of money that was added to a house just for somebody living in California was $110,000 in 2021. So, this idea of lots of equity, there are people that have lots of equity in their homes, and so they can do this. Okay, so let's go through it. Let's make sure that I'm explaining this okay. Okay.
Okay, so you're allowed to take 65%.
Right.
And then you get to that. Okay.
Right, and then so you have 1.6. You take out the 200 that they owe. Now you have 1,425,000 that's available.
And using that property too, that's interesting that you can do that.
Yeah, you bet.
And then get that bridge loan, and then there you are. There's your finance.
That's right. And then when they sell the home for $1 million, they pay off or down the bridge loan, right? And then refinance out of it.
They're on the hook for this bridge loan.
They're on the hook for the bridge loan. So what we have to do is we have to make sure that they have an exit strategy. All lenders want to know what the exit strategy is. And the exit strategy is they'll get regular traditional financing after they get done. A lot of times these people qualify for normal financing, but they're not going to do normal financing because they can't get their offer accepted. They can't get the property that they want. They want to go in with a non-contingent offer. They don't want to have to sell their home or even think about selling it in order to buy the home they want.
So 65% of 2.5 million, so the 35% is gonna be the cost of getting this loan?
No, it's not the cost, it's the equity. So the lender is not going to give them a 100% loan. They're always going to go down for risk factors. So it's only going to be a portion of the total value of both homes. Right? And the lower they go, the less risk it is. So it depends on how strong the borrowers are. I mean, we have people that are really strong, that have lots of income, right? But they can't buy the other home. They don't have the cash. It's all in 401ks or it's in IRAs or something like that. They need the cash and they want this house, but they want to buy it on a non-contingent basis. The cost is anywhere from 3 to 4 points. Mm-hmm, mm-hmm.
So like, very much similar to how many points?
Yeah, it's not really, it's private placement. You can call it hard money, but most people call it private placement because the people usually are really well qualified. And what's interesting is we're doing a loan right now for a couple that's called WaFd Bank. And they're very interesting because they have this exact same program, but they don't charge anywhere near to what private placement costs. This is a loan where the clients are buying a property for $2,500,000. They're selling a property that they have for $1.4 million, and the amount of money that they have to bring in to buy their $2.5 million home is $90,000. And they're paying about maybe 1.5 points. So it's amazing what you can do. And this is the second one that we're doing. I mean, they're all over the place, right? So the fact is that when you're in a situation where you want to be able to sell a home, these people want to buy a home, and they say, but we don't have the cash, this is the way that they can do it. And if they do it with somebody like WaFd Bank, it's not even private placement, it's actually it's a loan. They're a bank that specializes in lending on real estate with cross-collateralization. Yes, Alex?
On this situation, like the first home, would it have to be listed or in escrow?
Yes. Yeah, they do want the house. They do want to see that the house is listed. Mm-hmm. But they can have it listed by the time they close, right? So that it doesn't have to be listed right away. They can get ready. Yeah. Yeah. Yeah.
You want to sell the house within 11-month period, right?
Yes, the current home, right?
Current home.
Current home within 11 months. That's right.
Prepaid penalty on bridge loan?
There's no prepayment penalty.
Okay, so let's say, so they buy a house with bridge loan, right? So
Mhm.
two houses are under, the bank's gonna hold the title on it, right? So
The bank has a covered loan on, it's a blanket loan on both of them.
Okay, so
Mhm.
so are you able to sell the house? Because both houses are collateral under one loan, isn't it? How do you,
So what happens is when you sell the home, then the lender releases the lien on the other home.
oh, they do, okay.
Right,
Separate
okay.
lien, okay.
Right,
Okay.
right,
And then right after you do that, you need to refinance your current house.
right. So if you still owe the lender like $400,000, then you need to refinance out of that.
Okay, you gotta do it simultaneously? Or?
Yeah, yeah. But I mean, that part is easy. It's structuring the deal so that they can have a non-contingent offer because it gives the buyer so much more buying power. It's just unbelievable. Yeah,
Compete.
right.
And you're seeing it mainly with people that have a lot of equity in their home.
Right.
Yeah.
Yeah, you got to,
People that have lived there for 20 years.
for a long time. I mean, we get retirees that are like that are moving down, right?
Right.
And they don't have the cash, but they have equity, right? The deal with WaFd Bank is a really big deal because that allows them to not have to be private placement, get great pricing on the product, and we still get it done quickly. Vince?
This could be done from income property to income property,
Yes.
and would that affect if there was a 1031 exchange on that?
No. No. As long as you're going like to like and it's a rental property, it does not affect it.
Can
Yes.
this be done in other states, so if you're
Yes.
doing other states?
You just have to find a lender who is willing to cross on another property out of state, right? Okay, good questions. Really good. What's that? Yeah, we do out of state. That's right. Okay. All right. Let's go. Is that good? Okay. All right. Now, the next one that I'm going to give you is a case study. This is a real deal that happened. This is Charmaine. Charmaine is really an amazing a gal. We love her. And she was getting a little bit older. She had bad knees, but she lived in a tri-level home. She was unsure what her house would sell for. There was a lot of deferred maintenance. She wanted to stay in the area. She planned to sell her home and purchase a $535,000 home in Ventura. All right, now, the problem that we had with Charmaine is that she didn't have enough money. She could not qualify. She sold her home, and if she sold her home, she'd be able to put down a good-sized down payment, but she still could not qualify for the loan. So the question is, how could she qualify if she only had Social Security income? That's all the money she made, and she had a part-term job. I think it was at Walmart or something like that. That's all she had. She couldn't buy this home that she wanted to buy. But what I did was I said, well, Charmaine, do you have an IRA or a 401k? And she said, yes. I said, well, how much do you have? She said, I have $208,000. Now, this is something that most agents are not aware of. Lenders are aware of it. And it is an amazing program for people that have access to their IRA. So they've got to be 59 and a half or older to do this. But what happens is that the lender will say, okay, we will take that $208,000 and we will make it into a distribution. We'll divide it by 36 months, and the income for Charmaine was now $5,777 a month in addition to her Social Security. Now, people look at this and they go, okay, at the end of 3 years, what's she going to do, right? That's one of the questions that they have as well. You know, can she afford, is she getting herself into something that she shouldn't be getting herself into? And because that's all the money she had was $208,000. And so the way that this program works is that the lender is interested in monetizing the income and turning it into income. They want to take the IRA or the 401k and turn it into income. And the only way that they can do that, and these are for only qualified accounts, is to be able to take one distribution and put it in the bank. And when you put it in the bank and show it as a distribution, and you have an agreement from the Fidelity or whoever you're taking the money from, that you're going to get it on a monthly basis, the lender will count this as income. Now, the part that's really cool is that the lender is basically saying, just show us 1 month and we'll count it as income. After the close of escrow, the lender really is hands off. They don't continue to say, well, are you going to continue to get this income? Because after the sale closes, oftentimes people's circumstance changes and they don't need the income. In most cases, people, I don't know if you've ever been frustrated about this, but you know that they can make the payment, but they don't qualify under standard terms. Isn't that frustrating? I mean, that just gets my goat, right? And when you put in this kind of an offer, when you put in this kind of a possibility, all of a sudden there are thousands of more people that can qualify for financing, literally. And that's where your extra deals come in that we want you to have, those extra 4 deals. What questions do you have about that? You must have some about this, because it can be a little bit gnarly.
So if they don't need the 5,777, they just put it back in there?
Exactly. If it's an IRA, they can put it back and it's not taxed as long as they put it back within 60 days. Right. And they only need 1 distribution. Right? Now, what's interesting is through the use of Prop 19, her payments on her taxes came way down because they're only $300 a month, whereas before they would be much higher. So it's an amazing program. I mean, if you work with seniors, you know, when we're talking about reverse mortgages, which you're asking about, when you're working with seniors, this program is a lifesaver. It will help you sell more homes than you think possible. And what's interesting is that, I'll give you an example. This is a little bit unrelated, but it's the same type of thing. when the Dream for All program came out initially, how long did that, I believe it was $600 million last? Maybe it was 500 million. It lasted 13 days, right? And the reason why, does anybody know why so many people gobbled that up? Well, because the media actually said, hey, this is good, right? People actually asked the question, what are the possibilities? See, and that's what you want to ask your clients. Every time somebody calls me and says, I know I can't qualify, or I know this won't work, they always start out with that. And then I say, well, let's look at it and see what that looks like. And 9 times out of 10, we're able to figure it out. And so this is a really big deal. So people don't know about this. Retirees don't know about this. And so they automatically think that they don't qualify. But if you can have the deeper discussion, if you can add value to the relationship where they say, well, I know that this won't work, and you go, well, wait a minute. Do you have IRAs or 401ks? And they go, yeah, we got lots of that. I say, well, did you know you can use that as income? Chances are really good you can qualify for a property that you may not be able to qualify.
Now, we gave her for 36 months, so I guess realistically, does this person qualify?
Yes.
I mean, to be able to make that payment beyond the 36.
Yes. And we look at that really closely because we know that there's only going to be 36 months. We don't expect them to use that income. And so I asked her point blank, I said, well, if this were to go away, would you still be able to make the payments? And she said, yes. And what she said was, and this is really interesting, this is when you start getting creative, when you start saying, yeah, I can make it happen. She said, I have a sister that wants to come live with me and she's going to pay me rent. Bingo. But will the lender use the rent from the sister? No. Right? But will they use it from a qualified account? Yeah. So, I mean, there are deals out there. There's low-hanging fruit there. It's just a matter of finding it, right? Okay. All right, now we go to the next one. Oh,
It's really
Yeah.
important that because people are blasted every day with what the Fed's going to do and kind of hanging on that,
right.
right?
Mm-hmm.
And you open it up where that's...
Yeah, it blows it away. That's right. Right, and right now, where the rates are at right now is where they've been for the last 30 years on an average basis. So, I mean, people look at I had a lady direct message me on one of my social media feeds, and she said, 8% is horrible rate. And I thought to myself, I wonder if she rents, because if she rents, she's paying 100%. Right? 100%. Okay, Jerry and Susan. Quick example here. Wanted to move closer to grandchildren in Manhattan Beach. I don't know about you, but every time people come in to me and they say, I want to move to closer to our grandkids, they never say, I want to move closer to our children. It's always, I want to move closer to our grandkids. And they found a condo for $1.2 million. They have a home in Westlake that was $875,000 free and clear. Didn't know any money on it, right? All right, so Jerry and Susan wanted to buy this property for $1.2 million. So here's how it came down. Jerry and Susan, their combined Social Security income was $3,000 a month. They had other income for $1,000, so their total income was $4,000. After commissions, the net that they got from the sale of their home was $820,000. They found the condo for $1.275 million. After the down payment, the required loan was $455,000. The total payment for the new loan was $4,225. They had some cash, but they needed an income to qualify of $8,622. So, if you need income of $8,622 to qualify, and you can show $4,000, do you qualify? No. So what are they going to do? Now, we closed their loan, but how would we do that? Responsibly. How would we make it so that they could buy? They needed $8,000 to qualify. They had $4,000 in income. They had a pretty good sized down payment, but they still couldn't qualify for that $455,000 loan. So how did they buy?
So one of the grandkids?
Yep, that's what they did. No, not really. How would they buy? Anybody got any ideas on that? Reverse, exactly. We did what's called a jumbo reverse mortgage. And this is what happened. It's a private reverse mortgage. It's not considered a FHA loan. There's FHA reverse and then there's jumbo reverse. And the FHA and jumbo, they're very good. The private reverses will, by Blackstone is the company who invests in those, will go up to $4 million for a loan. The loan amount in this case with the reverse mortgage was $625,000. Their down payment was $650,000. They had increased reserves of $170,000. They had discretionary income, and their payment was $1,953 a month that included HOA, taxes, and insurance. And they moved in. That's pretty cool, right? Because with a reverse mortgage, you're not required to make the payment of the principal and interest that you normally would be. And what's interesting is reverse mortgages have not what they used to be. People get the idea that they're either going to do a reverse mortgage and leave no money to their children. They get this idea that they can't do both, but the reality is that they can do both. And the reason is they've changed a lot. They don't give as much money as they used to, and it is amazing what these loans will do. With reverse mortgages, you can treat it like a normal loan. You can make a payment, you can make an interest-only payment, or you can make no payment. With reverse mortgages, they allow for purchase and for refinance. For purchases especially, they are dynamite. Because what happens, and this is a book by the name, Wade Powell came out with this. He's a PhD in financial planning, and basically he talks about the idea that when you leave your money in your 401k and your IRA account and let it just grow, and use a reverse mortgage instead for your financing of where you live, what would normally be your mortgage payment, you will leave more money to your grandchildren and your children than if you did not have a reverse mortgage. You can actually have in his example, there's $1 million more left to heirs as a result of using a reverse mortgage as part of the strategy.
What is the difference between a private reverse mortgage and a reverse mortgage with FHAs?
A private, so FHA is guaranteed by the U.S. government under HUD, Housing and Urban Development, and it is a FHA product that has mortgage insurance, upfront mortgage insurance, just like a normal forward FHA does. Private is where they will actually allow you to be able to use the entire value of the home. When you get an FHA loan, they'll allow you to use about $1.1 million in value, and that's it. So if the house is worth $5 million, they will only make it as if it was $1.1 million. With a private, they will count the entire $5, so you get a lot more cash, right? And they can be used for purchases and refinances.
Either one, whether it's FHA or private, you don't have to make a payment.
Correct. And you can make a payment if you want to, interest only, you can do whatever you want with it. So, I mean, it is dynamite. So what we wanted to do today was to get you 3 or 4 different deals. It's 132. In your packet is a opportunity cost analysis for first-time home buyers, which is the last 3 pages. We won't go through that today because we need to end. But take a look at that because it's a great way to present this to your clients. We made the packet for you so you can present this to your clients. If you want it in electronic form, we can send it to you so you can also have something to present as well. So there is so much opportunity out there. We appreciate your time coming today. It is we'd love to work with you. We have a great team, and Gina and our team would just do a wonderful job.
I wanted to real quick, Patty, who is our president of Women's Council of Realtors, she does have an event next Wednesday that she wanted to talk about, and it's at the Moore Park Country Club, 11:30 to 2, and it's a lunch, so reach out to her.
Yes.
And they are on the desk, so they're always great events. I was on the board for 3 years, and I can't speak highly enough about Women's Council.
And even though it says women, men are welcome.
Yeah.
I go to them all the time. Okay, I'll say afterwards, the book The book is being used a lot right now for open houses. It's a great way to turn a cold lead into a hot lead. So I'll be glad to sign one for you. We do have extra books that you can use to give to your clients as well. So thanks for coming. Great to see you today. Appreciate it very much. Thank you.